Hey, good morning, everybody. Good little crowd. Thanks for being with us. I am joining a couple of minutes after I normally do. So y'all, I'm going to go ahead and jump right in, share my screen. We're going to start local. And then I've got what I think is a pretty interesting article from The Economist. It's real nerdy, but I've never really gone global in looking at housing market. And I read it about a week ago or a couple days ago, and thought, boy, it'd be pretty interesting to look at what the United States is doing in housing relative to the rest of the world. And I think you'll find a couple of the pieces of that interesting. But first, taking a look at Indianapolis. Just give me a second. I'm going to share this trusty spreadsheet. Okay, so Rex and I bumped off of our rotation. So I've now looked at this 2 weeks in a row. So going back to June 7th, now today we have very similar numbers to what we were looking at last week, but one thing in particular changed. And my guess is y'all have probably felt this or experienced this, but stuff is moving faster for sure. So looking here at the data, we've got 1,458 active single family houses for sale in Indianapolis. And we've been pretty steady on that number. You notice that we're now back to where we started the year, basically. So we kind of started just shy of 1,500, got down to right at 1,000 in March, and then we've kind of slowly crept back up from the middle of April to the middle of June. And just for reference point, that's very normal, right? So it is normal to see a decent sized inventory at the very start of the year, and that through the spring market inventory comes down because there's so much buying activity. And then at some point in the summer, it starts to tweak back up with inventory oftentimes peaking like late summer. So in July and August, buying activity really tends to cool down. And so inventory starts to creep back up. So the rate here of inventory going down and starting to pick back up is very normal. What's abnormal is that we started the year with less than 1,500 houses. So we have a very low inventory still, but it is functioning on a normal cycle of when is it higher, when is it lower, and at what rate does it change. But yeah, I mean, look, an increase from 1,000 to 1,400 over the course of 2 months, it doesn't really do much for the marketplace. It's a normal cycle, but really, I think to change the dynamic, we'd have to be seeing a much higher increase in inventory. We've had a good number of houses list in the last 2 weeks, over 400. Which is the highest number since the first 2 weeks of the year. We have 1,479 pending. So again, our pending number still hovers just a little bit higher than our actives. One way to evidence just a firm seller's market, right? More pendings than actives. Easy way to deduce which side of the transaction tends to have most leverage. And it's for sure the seller. Here's the number that was a discernible change. So this is cumulative days on market of the houses that have closed in the last 30 days. So, excuse me, anything that has closed from the middle of May to the middle of June. These were probably buyers that were active in late March, early April, went under contract in early to mid, say late April, early March, closing late May, early June. So really just typical peak spring activity. The last 30 days of closings would show us at what rate were houses selling at that peak level of activity, and that 20 number. So that's not days of inventory. We're still at 42 days of inventory, but that 20 number is the lowest that we've seen since interest rates went up in the middle of last year. So just an indicator that when we would expect to see houses moving very quickly, they did. So in interest rates, average 30-year fixed interest rate for a good credit score buyer has held now pretty steady. It's in the low sevens, although I definitely keep hearing of buyers getting rates lower than this. So I think maybe lenders are running a lot of promotions to try to be competitive right now and maybe eating into their margin to try to get rates into the low sixes, but the average is still out there around 7. So all that compresses to say we've experienced a very normal first half of the year in terms of the rate of inventory kind of starting high, coming down, creeping back up, the pace of the market being at its peak in May. So all that's good news in a sense, and that it feels very normal and maybe even a bit more predictable. So the pace at which the market is moving, very normal. The reason that transaction count is down, it really, everything I'm looking at would say it's not because buyers are concerned. It's really not even so much because of interest rates. That I think all this says buyers have pretty much adjusted to interest rates. Certainly there's some people sitting on the sidelines, but transaction count is down more because of inventory continuing to be really low. So I don't know if there's a whole lot new there. I'm very interested to see what the second half of the year looks like because this data here through the first half of the year, it's the most normal rhythm that we have had since 2018. So 19, 20, 21, first half of 22 had these kind of abnormal, like, wait, everything's kind of out of whack in terms of that seasonal cycle that we normally have. But it appears to me in 23 to be back. So that means inventory would continue to increase. This days on market will slow down. We'll see fewer multiple offers. We'll see inventory start to creep up. And then August might feel like a normal August, kind of coming off that high of spring and early summer, that back to school lull, within a pickup in between Labor Day and Thanksgiving. It had been super predictable for those that haven't been in the business since before the pandemic. It was like this norm of, oh yeah, late spring is going to be really hot, super active, very competitive. It'll start to slow down in the summer. By the second half of the summer, it'll feel really slow, kind of coming into back to school. And then there'll be some little chunk of time in between Labor Day and Thanksgiving where it heats back up. And then it would, from Thanksgiving to the end of the year, get really slow, gearing up for all these new listings in January. So that's been our normal seasonal cycle, and it looks like we might be on that for 23. Okay, I'm gonna shift gears. I'll stop my share here for a second. So The Economist is a publication that I enjoy. I get their like daily email. I find them to be kind of similar to what I've shared about Lawrence Yun, the economist that works for NAR. I don't get as much of the fear narrative from a publication like The Economist, so I tend to enjoy reading it. They don't write about the housing market all that often. But I think there was this really interesting article this week about the global housing market. I want you to notice in the title, even as I've said, they don't tend to, buy into this fear narrative quite as much. I want you to read the title and kind of gauge what your internal response is when you read the title. So give me just a second here. Okay, there you go. is the global housing slump over? So even right there in the title, from a publication that I think generally stays away from the fear narrative, really what they're saying is activity and our prices increasing and picking up, kind of gaining steam. But the way they asked the question was, is the global housing slump over, right? Kind of takes the negative approach in wording, pretty typical. So I'm just wanting you to gain that perspective of kind of seeing through that. And then maybe asking the question like, wait a minute, what do they mean by slump? So I think, what do they mean by slump is a key question. And then also, to what degree is something happening? This article talks a lot about Australia, for example. To what degree is that relevant to Indianapolis? Well, I don't think it's super relevant, but I do think what's happening with housing in the United States in comparison to the global market, in your day-to-day, does it impact you? No. Is it worth an occasional check-in to try to increase your understanding of why does housing in the United States perform so consistently in comparison to other parts of the world, or in comparison to any other type of asset class? It's one of the things that our National Association really kind of like trumpets a lot, is that housing in the United States over the last 100 years has been among the most predictable, positive performing things that you can own anywhere in the world. So a couple things I want to highlight from this article, and I'm going to send out, the article requires a subscription. So I'm going to print a PDF and have Rosie email that out later as attachment so you can see it. So a couple things to highlight here. This first one, in March 2022, the month that the Federal Reserve started raising rates to combat inflation, the average value of a house in a rich country was 41% higher than 5 years earlier. And yes, very clearly, the United States is in the category of a rich country. So this would be the majority of Europe, certainly Canada, United States, Australia. And in the United States, actually, that 41% number would be slightly higher. But I think that's worth noting, is that this is the reason the Federal Reserve started to raise rates. Because if housing had increased by 41% in a 5-year period, very little else was doing that. Wages certainly weren't doing that. The market IRAs, 401ks were not doing that. And so they really had to try to figure out, how can we slow down that increase in the price of houses? I don't know this, but I think from other things I've read, my estimation would be that the United States would even like outperform the kind of global rich country category. So let's say it was 50% higher. And it, kind of bringing that to the ground in Indianapolis, think about that. Go back to 2017. Y'all know houses that would have traded hands in 2017 for $300,000. It wouldn't surprise any of us, I don't think, to say, yeah, a house that sold for $300,000 in 2017 might be trading for $450,000 by 2022, right? That's a $150,000 price increase in a market that had been considered modest, but that's basically what happened here. So just as a reference point, I think it's kind of interesting to note that what was happening in Indy was on track with the United States and most of the more wealthy countries in the world. Second thing I want to highlight here. So I'm just going to read this whole paragraph, actually. Global house prices have certainly come off the boil, meaning that rapid 5-year increase from 17 to 22. Everybody agrees. From the middle of last year to the middle of this year, that's slowed down. So globally, they're 3% below their recent peak, or about 9% once adjusted for inflation. This is in line with the average correction since the late 19th century. So translating that, it means that globally, home prices are slightly lower now than they were a year ago. See this little handy chart, but that is very much in line with what corrections typically have done in the housing market. So if you want to visualize this, if you all can see my cursor, this spike here from the pandemic to the middle of last year, so March of 20 through March of 22, you notice that is an abnormal increase. So if you take from 1990 to 2020, you had a 30-year period of time where even with the boom of the like 2005 and 6 boom and the 2008 and 9 crash, you've actually got a fairly consistent increase in the value of houses. Well, from 20 to 22, we kind of got off of that rhythm globally, had an abnormal spike. And normally what happens is that that'll go on for some period of time, and then the market will correct and get back onto its normal increase line. Well, globally, that's what happened. What the article is going to point out is that this little dip right here hasn't really happened in the United States. And it certainly hasn't happened in markets like Indianapolis. Where it has happened in the United States, it mentions San Francisco, for example. This chart would be a similar ratio to what's happened in San Francisco, just uber high housing prices that kind of got, out of hand in that 20 to 22 window, had seen a little bit of a downturn and correction. In a market like Indianapolis, what's really happened is just the rate of increase has slowed down. The second half of this paragraph, yet this episode is different because it followed a boom during the pandemic when prices rose at their fastest rates of all time. The upshot is that real house prices remain miles above the level of 2019. Many millennials and Gen Zers who had dreamt that a crash would allow them to buy their first house are no doubt disappointed. If there is a sentence that many of you could probably like really quickly practically apply to your day-to-day, and you're thinking like, oh my gosh, yeah, I know 3 people that fit into this, they may not even have embraced that disappointment yet, right? So that feeling of I'm waiting on a crash that would then allow me to buy my first house, and that sense of disappointment of like, wait a minute, we're a year into this attempt to cool the marketplace, and it's slowed down a little bit. Prices are going up by 3 or 4%, not 15, but inventory is still crazy low. Sellers still have the leverage. And I think a lot of predictions are we're going to get back onto a normal 6, 7, 8% year-over-year price increase. So I thought it was interesting that what we're seeing and experiencing in Indianapolis really does align with the global housing market. But if anything, our performance in terms of price is slightly better. So we had a similar rate of increase in prices from middle of 20 to middle of 22. What we haven't seen in Indy is this slight correction that's happened in the last 10 or 11 months. Okay. There's a lot of info here. I wanted to highlight one more thing here. Give me a second. Remembering where this is. Yeah, right here. I thought this was well said. A structural shortage of housing means that there is almost always someone willing to buy if someone else cannot. And there is little sign that people are losing their taste for home offices and weightlifting in the attic. So what I translate that to is, even though a decent chunk of our market is negatively impacted by interest rates, first-time home buyers, for example, the balance of inventory to demand was so off. Somebody on my team yesterday, I think one way to boil this down is, a year and a half ago, had I listed this house, I know I would have had 30 offers, and now I'm getting 4 or 5, right? Doesn't actually do a whole lot to change the output in the market. So I think that's a good illustration of this. Higher interest rates and a little bit of a cool down have affected people, but that structural shortage of housing means that the line of potential buyers is still fairly long. And so that's why I think we're experiencing the type of imbalance that we still have, even though we've cooled off. And I know we kind of beat this horse dead, but as if you take a look at this article and read through it, I think you're going to see, like, yeah, the interest rates they're an attempt to deal with low supply. But they really haven't done that. It's cooled down the competition, but the supply hasn't moved in a material way. Certainly hasn't in Indianapolis, hasn't in most of the United States, and it hasn't globally. So without good solutions there to increase supply, which is kind of a bigger conversation, I don't think there's much reason to assume that we're in for a correction. This might be something, this article, if you have a buyer that's thinking through, like, I just know it. I know prices are going to crash. I think there's tons of ways to illustrate to them that that's not likely to be the case. If they're more of a kind of philosophical academic thinker, an article like this might be helpful to share with them, particularly that comment about 2 generations of buyers kind of sitting on the sidelines waiting, now increasingly being disappointed that what they thought was going to happen isn't. So like we always say, if Rex or I could be helpful in any way in talking through some of this, or maybe even talking with one of your clients, always feel free to let us know. Happy to do that. Hope you enjoyed this article. Apologies for the super nerdy, thick academic nature of it, but I hope you find it helpful. Great to be with you all this morning. Hope to see or talk to you in the next week. I'll be back with you in 2 weeks to take a look at some of this info again. Have a great Wednesday.